In this video, we're going to prepare the operating cash flow section of our cash flow statement for LA Gear. Again, by convention, we begin our operating cash flows with net income. So let's pick net income from our list. In year two, we want to pick up the year two net income. So we're going to our income statement, click on net income for year two. Also, by convention, the first thing appearing below net income on our cash flow statement is we add back, recall, depreciation expense. So we're going to hit depreciation expense, and we can find our depreciation expense on our income statement. And again, year two, our depreciation expense was $1,199, and we hit enter. Then we're going to pick up the changes in largely our operating assets. We're going to begin with accounts receivable, and we need to pick up the change in our balance sheet accounts between year one and year two. So let's hit equals. Let's click on the balance sheet tab. In year one, our accounts receivable was $49,000. In year two, it was $100,000. So we see accounts receivable went up. An increase in assets is a use of cash, so we want this to be a negative number. So we want to take the smaller number, the year one, and subtract the larger number, year two. And again, there is our increase in accounts receivable we treat as a cash outflow. Next thing on our balance sheet was our inventory. So let's pick up inventory. And again, let's go over to our balance sheet. Inventories went from $66,000 to $139,000. They went up. So again, we want a negative number. So let's take the $66,000, the smaller number, and subtract the larger number. Now notice, inventories is right below accounts receivable on our balance sheet, and then below that is prepaids. So what we can really do then for prepaids, and we could have done this for inventory as well, let's find our prepaid expenses. And we can simply copy that down. And notice up here, we've got B8 minus C8. When we copy that down, that'll change to B9 and C9. So we've picked up all of our current assets. Let's go to our balance sheet again. And now we're going to pick up our liabilities. And I'm pretty sure accounts payable is our first liability. So let's go ahead and pick that up. Equals. Click on the balance sheet tab. And well, line of credit was our first one, but line of credit is going to be one of our financing cash flows. We've looked to outside investors to provide us cash in exchange for us paying them interest. So our first operating one is accounts payable. And it went from $7,000 to $25,000. So an increase in liabilities. This is a source of cash. So we want a positive number. So we'll take that $25,000 and we'll subtract the smaller number in year one of $7,748. And notice below that, then we've got accrued compensation and accrued expenses. So we're going to want to pick up those accounts next on our cash flow statement. So accrued expenses and accrued compensation. I think I got that in the correct order. Oh, compensation was first, accrued expenses was second. And I'm going to copy this down, so I want to make sure I have those in that correct order. So accrued compensation and accrued expenses, and I can simply take that formula and copy it down. I think that's all we've got. Let's look over here. We've got other assets. We're going to pick up other assets as an operating cash flow. Sometimes it might go in investing, sometimes operating. It doesn't really matter. It's a small amount. If it's an asset that's going to provide future or generate future benefits or future revenues for multiple periods of time, maybe we think about it as an investing cash flow. I'm not sure what other assets is, and we're just going to put it on our cash flow statement as an operating cash flow. So let's come to our cash flow statement. Other assets. Go to our balance sheet tab. Other assets went up from 1,019 to 1,265. So we've invested additional money. We've had a cash outflow, so we want a negative number. So again, we're going to want to take the small number, subtract the large one, and there we have it. And I can go ahead and sum this column. And if we've done it right, your total will turn blue. And we can highlight all of those and then just copy it across for year 3. You're on your own for calculating your financing cash flows as well as your investing cash flows. The only accounts that we have not yet considered on our balance sheet are our plant, property, equipment, really our net plant, property, equipment, and our line of credit, as well as our common stock. The line of credit and the common stock are financing, and the purchase of plant, property, equipment are an investing cash flow. Be sure at the bottom of your cash flow statement that if you take the change in cash, add to it the beginning cash, that does indeed tie to the ending cash on your balance sheet.